Ladies and gentlemen, Jerome Powell, the Federal Reserve Chairman, has delivered a 25 basis point or 0.25% interest rate cut. And this is largely expected. And now we're all waiting. What does this mean to the stock market direction? I've gotten into a bet, and I think it's important for you to take a look at some of the analyses leading to my bet versus another person. Let's watch on, shall we? So really the bet is whether the S&P 500 will break 7,000 points. Right now it's about 6,800 plus points, and I've entered into a bet. That's not very common, but this bet is between me and Ben, my son. And I'll give you the different differing view. So Jerome Powell, as expected, has delivered a cut. And fortunately, for now, the market has reacted quite positively, even though it was a quite anticipated cut. But this is a cut that has the strongest internal split since 2019 in the FOMC, Federal Reserve Open Market Committee. And we should take a look at the things that are inside this cut. So what the Federal Reserve actually did was they delivered the rate cut. Now the interest rate has gone down. By the way, this also means that most likely we're going to have a further interest rate adjustment throughout the whole world, including Singapore. Our T-bills are likely to go down further. Our fixed D is likely to go down further. SSB is likely to go down further. And more importantly is, I think the ringgit, okay, will further strengthen as well. So these are things that are happening on the rate cut side of things. But there are more than that. The the Federal Reserve also announced that they'll do a $40 billion monthly T-bill purchase restart. What do they mean by that? They will start buying T-bills. When they buy T-bills, they will have to pay. So in short, this T-bill purchase, it's like a QE, quantitative easing. It's not officially called quantitative easing, but it's like I'll think of it like a mini QE in terms of liquidity impact. So quantitative easing is always, in my opinion, good for the stock market, and it's what economists would call a expansionary monetary policy. So it would serve to stimulate the economy, which is what their objective is. And right now they only predict that there will be one more rate cut for 2026. So it is a mixed bag, not hawkish, not dovish kind of announcement yesterday night. Now, internally in the Federal Reserve Open Market Committee, there was a 9-3 split. There will be three persons have very different views. There were two of them actually said that they don't think there's a need for a rate cut. Okay. And on the other hand, there was one person say that they should have a 50 basis point cut. And of course, Jerome Powell kind of tread the middle ground. So even the experts have differing view on where the interest rate direction should be. Now, in Jerome Powell's message to the analysts and to the media is basically saying that, well, the tariffs that Donald Trump has imposed on the rest of the world, it is, the cause of a one-time jump in prices, but it is not overheating and not excessive, and neither is it overheating the economy. So this one-time jump is a temporary impact, and therefore they don't see a necessity to react to this one-time jump. Now, remember, inflation is defined as a sustained increase. Your prices have to increase non-stop. If it's a one-time jump, by definition, that is not called an inflation. Now, he actually mentioned something about the labor market, especially on the weak on it weaker than what the headline suggested. So, Federal Reserve Chairman Jerome Powell actually said that the US may be drastically overstating job numbers. So that's usually something quite positive for stock market in the sense that it actually means that their job market is not strong. Therefore, they have to do something to stimulate the economy. He actually said that the country could be losing as many as 20,000 jobs a month, and this is a concern that drove a decision to cut interest rate, and that is quite something quite serious that we should all be cognizant of. My gut feel is that this is a result of AI and maybe overhiring during the COVID time and things like that. But at this juncture, because the government departments were shut down earlier this year, so they couldn't be very sure on some of these statistics. Now, the good thing is that they do not see a recession, even though they see an economic slowdown. Economic slowdown means the growth has slowed down, is still expanding, so therefore they don't see a recession in US, and I think that's something very positive. The Federal Reserve have revised some of their economic projection, and right now they are looking at peak inflation around 2-ish%, 2.9%, and moving downwards. Okay, so I think that's great. Employment numbers 4.5%. GDP growth for next year, they expect it to be around 2.3%. That is a stronger than 1.8% previously projected. So I think they do feel that the economy inherently is strong. It doesn't mean that when job markets are weak, the economy has to be weak also. So he's coming to the twilight of his career as a Federal Reserve Chairman. He wishes to hand over the position to the new Federal Reserve Chairman in a more stable position. So he hoped to bring down the inflation to 2%. Okay, it's not there yet, but it's very close already. And he hoped to preserve the employment gains. Hopefully the market doesn't weaken some more, and he wants to achieve some kind of a soft landing, no recession. So he's very clear on this approach. So therefore, in this kind of position, any kind of changes to monetary policy will be a minute one. Well, the stock market rallied, okay, rallied pretty decently. I wouldn't say strongly, decently. The S&P 500 right now is at 6,886 points, okay, just a few points shy of 96920, which is the all-time high. And whether this trajectory will continue, we don't know. But this is where Ben and I have a differing position. So we have entered a bet. Okay, the bet is I believe that the stock market will breach 7,000 points. The S&P 500 will breach 7,000 points by end of this month. Ben do not think so. Now, just in case you might think, why am I entering a bet with my son? Well, this is number one for fun. Number two is Ben and I are, of course, financial enthusiasts. He manages the family fund, and I before I make any financial decision, I usually check in with him to triangulate our thinking. He's pretty bright, in fact, very bright financially, and both of us have differing view for the first time. Usually, his view are not far away from mine, but this time it's quite drastically different. I'll share with you the difference. So my case is I think you will breach 7,000 points because at least the interest rate has been cut. So the downside risk is removed. So my fear was that there was no interest rate cut, then the stock market would tank. Now I don't think that because of interest rate cut, the stock market will boom big time because that's highly anticipated. But my case for a stock market rise is largely because usually there is a Santa Claus rally. In fact, about more than two-thirds of the time, 73% of the time over the last 50 years, usually there's a Santa Claus rally in December. So I think at least you will breach, from its position now 6,886, to 7,000 is just a little bit difference, right? And there's a lot of political pressure from Donald Trump. Donald Trump already said basket, you should be cutting 50% basis point or whatever more than that. Just basically swanning this Jerome Powell. And he's already positioning possibly Kevin Hassett to the position of Federal Reserve Chairman next to take over Jerome Powell. And this guy just listens to Trump. From what I read about. So the directions of everybody quickly take up buying positions to ride the wave, and there's a lot of funds that are underperforming for the whole of this year. A lot of them sell out during big time during the crash of April. And they did not come back. So I think will be a lot of FOMO accelerators, as to say. So I think it's only 1.7%. I think it's noise, I think it's doable, but that's not what my son thinks. Ben thinks that 7,000 points it's unlikely because he says that by looking at the technical side of things, the selling volume still dominate the buying volume. So there's a lot of buyers more waiting to buy around the 6,500 points or so rather than pushing it up to 7,000 points. And he thinks that the interest rate cut is already fully priced in, and you don't think that there's any more upside for interest rate cuts. So of course, all the mega caps are the one that's driving it. All the rest of market is pretty fragile. That's his case. Okay, so he thinks that it's unlikely. So we enter into a bet. So who will win the bet? Well, right now I think that we enter a bet. So the bet is that we will have a massage. Okay, both of us will go for a massage, and whoever wins the bet now will get a free massage paid for 2 hours. Okay, and the other one who lost will have to pay for the massage. Okay, so we both go for it, and we have a good father son time as well. I actually think that I will be correct, but it's hard to say, right? So I think that the Federal Reserve have completely removed the risk of the downside. Okay, and barring any unforeseen circumstances, they're they are already more or less started in some sense some form of money printing. So I think that is very likely to just cross the line at 7,000. Okay, well, we don't know, right? We'll see who wins. Who you support the bet, right? But let me know in the YouTube chat who do you think will win. Okay, regardless, both of us stay invested. Okay, both of us stay invested. We're not buying, we're not chasing numbers. Whenever both of us have something in common that we're both crash buyers, and we've really taken up all our positions, and he has his way of managing the fund. From there, I just do some simple rebalancing. He's a bit more technical than I do. The things he does, I completely don't understand in terms of analysis and things like that. But we both stay invested. Okay, so I think that regardless of whoever wins, 2026 will probably look more positive as well. And let's see how it races to the end of the month and end of the year. Join us in this discussion. Okay, I hope to see you in my video. Thank you. I'll see you. Bye bye.